Good morning. It's just turned 9 o'clock, so I will start. Thank you to everyone that's joining us after a nice long weekend for those that took Monday off. What I plan to cover today is I'll cover the usual performance updates. I'll give you an attribution showing you exactly where the performance came from. But today I want to speak about thematic investing and to show you how we actually utilize thematic investing in the construction of your portfolios. So we'll chat a little bit about that. And I did cover the Regulation 28 update in the last session, but I will go over it again. I will just mention some of the changes that the regulators are proposing with regards to Regulation 28. And then I will have some time at the end for questions. So I'll be happy to answer some questions for you. And if you'd like, you can always email us after the session if there's something else that you would like answered. So as always, I'd like to start off with the mission and vision statement of SURF, the Sygnia Umbrella Retirement Fund. And our mission really is to restore confidence in the retirement fund industry. We try to have innovative products and services, and we want to make it easy for retirement fund members to plan for a comfortable retirement in the future. And our vision is to really enable these life-changing and dignified retirement outcomes so that members can retire comfortably. So in terms of performance, the performance of the portfolios that I will cover will be the default portfolio. So those are all of the life stage portfolios. So just a reminder on what the life stage looks like. At the moment, the life stage model is a model whereby members are defaulted to certain portfolios according to their age. And as members get older and closer to that retirement age, we automatically de-risk members from more aggressive to more conservative portfolios. So as you get closer and closer to retirement, you'll have less equities in your portfolios, you'll have more bonds and cash in your portfolios, and that way your portfolio is safer and able to withstand some if there's some turbulent market conditions. So if a member has more than 6 years to retirement, so all of your younger members will be defaulted in the 70 portfolios. Now the number in the name of the portfolios is indicative of the approximate equity allocation. So the 70 portfolio will have about 70% allocation to equity. And as you get closer to normal retirement age, you can see how we de-risk you from the 70 portfolio to the 60 to the 50, and then just before retirement, members will be invested in the 40 portfolio that has about 40% allocation to equities. And every management committee has the choice to choose one of the 3 life stage models available. So it's either the skeleton range, which is completely passive and very low cost, the signature range that utilizes passive and active managers, and in the synergy range that's mostly active, with active managers managing the local portion, and the offshore portion of all 3 ranges is exactly the same. I will show you the details of these portfolios a little bit later on, where we can look at the constructs when we're talking about the themes, and you can see some of those themes coming through in the portfolios. From a risk and return perspective, as I mentioned, younger members can take on more risk. For younger members, anybody in their 20s, 30s, 40s, and even, in their early 50s can withstand volatility. We know that markets go in cycles, so they do dip sometimes, but then they do recover. And with older members, it is often safer for older members to have a lower risk portfolios, as they might not have enough time to actually ride the ups and downs of the market. So from a risk and return perspective, if you look at risk on the horizontal axis, the further right you look, the more risk a portfolio is taking on, and the corresponding return is on the vertical axis. So theoretically speaking, the higher the risk, the higher the return, and that's why your 70 portfolios, you can see, are further right on this chart, taking on more risk, but we do expect them to give us a higher return over the long term, whereas looking at the lower risk portfolios, your 40 portfolios, they take on less risk, but we expect lower returns from our less risky portfolios over the long term. So this is just a quick summary of what the life stage models are about. And I will now take you through the portfolio structure. Now, both the signature and the skeleton portfolios have the same asset allocation. Where the differences come in is with the signature range, we're using that blend of active and passive, whereas the skeleton range is completely passive. And you can see that from a construct perspective, from an asset allocation perspective, you would be invested in various asset classes, with the 70 portfolios having higher weightings to the risky asset classes such as local and global equities, whereas the 40 portfolios looking further to the right, you'll see that they have less equities and higher allocations to your safer type of investments like bonds, like cash, like income. And within each portfolios, we have the strategic model that tells us what the long-term asset allocation of the portfolio should be, whereas the tactical model is looking at the portfolio today or as at the end of a month, and you would look, and this is exactly where you are currently invested. So we do make tactical changes depending on our views on the current market environment. So for example, looking at the equity building block, if we're focusing on the 70 portfolio, that's the one furthest to the left, you can see that by design, the portfolio should have about 48% in equities, whereas at the moment we are sitting at 47%. So we're slightly underweight local equities. In the bond space, we're viewing bonds favorably in the current market environment, and you can see that strategically we should have about 13%, but we're currently a little bit over at 14%. Likewise, with the income and the money market, you can see that the strategic and tactical numbers do differ. So strategically, we would want to have about 10% in income and 1% in money market. And due to the very low interest rates, we're not getting as high returns from income and money market because interest rates were cut quite aggressively last year, and that is the reason why we underweight there. So instead of 10, we're only holding 7% in income, and instead of 1% in money market, we're just holding 0.2%. In the global equity space, there's a lot of diversification that global assets can provide. There's a lot to choose from on the global side. So you can see instead of 22%, we're holding closer to 27%. And on the global bond side, strategically, we should have about 4%, but currently we're at 0%. This is due to the 0 interest rates in most developed countries outside of South Africa. In terms of performance, as you can appreciate, the last year has been very volatile. There has been a lot going on in terms of news events. We know that news events do affect sentiment. They do affect the way that people invest monies. And if we focus on the 1-year number on this table, this is the 1-year performance of various indices, and the measurement period of 1 year starts on 1 April 2020, and it's measured right up until the end of March 2021. Now, if you think about 1 April 2020, South Africa had just gone into a lockdown. We were downgraded to junk status officially. There was a lot going on in terms of global news following the kind of COVID-19 trends and lockdowns across the globe. There were Brexit negotiations that were constantly in the news. There was elections in the US that caused a lot of volatility in the markets, with those debates happening between Donald Trump and Joe Biden. So a lot of news events that caused a lot of volatility in the markets. But despite all that volatility, we can see some phenomenal returns over the 1-year number. 1 April 2020 last year, markets were down. There was a lot of nervousness in the markets due to lockdowns. Investors were asking themselves the questions, how do I invest in the market when all of these businesses are closed? So how do you, for example, buy a share in, be it a retailer or a producer of alcoholic beverages? It's difficult to have faith in a share like that when their businesses were closed and could not operate. But despite that, when governments came forward to say that they will support these businesses, they will provide, fiscal support from the monetary side, they cut interest rates. On the back of that support, investors became a little bit more comfortable with the markets, and markets recovered relatively quickly with a lot of volatility, but there was a strong recovery. And especially in the fourth quarter of last year, when a lot of regulators around the globe started approving vaccines and having their plans of how they would vaccinate their populations, that was viewed very positively by investors. As of course, as soon as everybody is vaccinated, the sooner we get the world's population vaccinated, the sooner we can get back to some sort of normality where we can avoid lockdowns and stop worrying about third waves, fourth waves, etc. when it comes to the COVID-19 pandemic. So looking at this 1 year, some of the numbers that I want to highlight would be the SWIX index. The SWIX index is something that we track in your portfolios, and we can see that over the 1 year, it gave us 51.5%. So it's not often that we see such high double-digit returns, but of course, we have to remember that it did come off a low base as well. Looking a little bit further down, still on the top block of this table, you'll see that we have the performance of the 3 super sectors of the JSE. So if you look at all the stocks listed on the Johannesburg Stock Exchange, for example, you can divide them according to their, the businesses or the sectors that they operate in. So if we look at resources, industrials, and financial separately, you can see the performance was quite different, where resources gave us over 90%, whereas industrials and financials gave us 37%. So we can see then that the local market was largely driven by that strong performance in the resources sector. Looking a little bit further down, I have mentioned this in previous webinars, but we don't have any direct exposure to South African listed property. South African listed property has struggled. However, the 1 year number is positive at 34.4%, but you will see the 3 year and the 5 year numbers are still giving us negative returns. So we still don't have any direct exposure to local property, not to say that we wouldn't want exposure at some stage, but for the moment, we haven't invested in SA listed property. And by avoiding this sector of the local market that hasn't been performing well, that has added positively to the performance of our portfolios. And then the global portion of portfolios. So all of those MSCI indices that you see kind of in this third section of this table. Global portion of portfolios really helped last year. When the rand was weakening, it was really this portion of the portfolios that was carrying the performance in a lot of the months. However, the rand has been strengthening now, and over this 1 year period from April last year to the end of March this year, the rand has strengthened by just over 17%. Now, when the rand is strengthening, when you invest outside of South Africa, it impacts the global return negatively when you convert that global return back in rands. But the opposite is also true. If the rand had to start weakening again, and we invest outside of South Africa, converting that dollar return back into rands would add positively to your portfolios. It's difficult to call where the exchange rate will go, especially on a day-to-day or month-to-month basis. That's why it's really good to have this kind of portfolio that invests both locally and globally and across various asset classes, and to have a very well diversified portfolio. But nevertheless, in rand terms, bearing in mind that the rand strength has affected these figures. In rand terms, the MSCI World Index gave us 27.4%. This is a measure of stocks in developed markets such as the US, the Eurozone. The line underneath that is the MSCI Emerging Markets Index in Rand, and we can see emerging markets have actually outperformed developed markets, largely driven by strong performance in China and some of the Asian economies. And then the MSCI All Country is a blend between developed markets as well as emerging markets. And we can see that figure is at 27.9%. But overall, if we're focusing on the 1 year numbers, we can see strong returns across all asset classes. So it's no surprise then when I show you the 1-year figures of your portfolio, bearing in mind that they do invest about 30% outside of South Africa. The other 70% is invested locally in South Africa. So it's a nice blend of both local and global assets, and a blend between equities, bonds, income, and money market instruments. And focusing on the 70 portfolios where we do expect most members will spend the majority of their working lives being invested in, we can see that the Signature 70 portfolio gave us 33.8% for the year. The Skeleton portfolio, the Skeleton 70 portfolio gave us 32.9% for the year, and the Synergy portfolio gave us 37.9% for the year. All three of these portfolios are way ahead of the strategic benchmark that was at 31.4%. If you look a little bit further down, you'll see the performance of the more conservative portfolios, so the 60, 50, and 40 portfolios. You can see that the returns are slightly lower, but still very good double-digit returns from the full range of portfolios. So it's all good and well to look at the performance of your portfolios, but where did that performance come from? Well, I did highlight that the local market has done very well. So we can see that the Swix index gave us 51.5%, a big portion of your portfolio, and we'll have a look later on again. But I showed you the strategic asset allocation. We're investing at the moment about 47% in local equities. So almost half of your portfolio is invested in local equities. So when the local market does well, it does positively impact the performance of your portfolios. The next biggest local asset class that we invest in is bonds. And bonds have also given us a really good return of 17% over the year. And if you look a little bit further down at the STEFI index, that is really representative of what cash returns would have been. And you can see that relative to cash, bonds have done phenomenally well over the last year. So that 17% has contributed really positively to your portfolios. And despite the fact that over the last year we have seen rand strength, the global portion of your portfolios has also really added positively to the returns. If we look at the Signature 70 fund and looking at it relative to some of the active managers that are available as member investment choice, we can see that, and bearing in mind that some active managers are included in the portfolio construct of the Signature 70 fund, we can see that there is quite a bit of differential in performance. So again, focusing on the 1-year number, we did have a look at this 33.8% for the Signature 70 fund. We can see that Allan Gray underperformed the Signature 70 fund, giving us a slightly lower return at 31.3%. Coronation has performed phenomenally well over the last year. The good news is that the Coronation equity portion has been included in your Signature portfolio. So there is an allocation to Coronation in your Signature portfolio. So it has benefited from those strong returns. Ford has struggled with their 1-year number, so giving us 25.9%. 91, another manager that is in your Signature 70 portfolio, gave us 33% for the year. And the Sharia portfolio, suitable for investors that want to invest by following Islamic laws, has given us 28.4%. But overall, very good positive performance across all portfolios, both single managers as well as these multi-manager portfolios. Always nice to look at the performance over the long term, so the cumulative performance. So this chart shows us what 100 Rand invested once would have grown throughout this period. We chose an inception date of May 2012, and the reason for that is because this is the inception date of the Synergy range. So this is actual true performance. It's not back-tested kind of performance. And what we can see is if you invested 100 Rand once in these various portfolios, all of the lines have grown, so you can see that upward trend. But what's quite visible to see is that it doesn't grow in a smooth line. There is volatility in the markets, not just volatility that we saw in 2020 due to COVID-19, the elections, and all these other news events that I mentioned. But volatility is something that's quite constant in the markets. If you look at, how the performance of the JSE will be today versus tomorrow, there's ups and downs consistently. But what you can clearly see is, as much as there is volatilities, these portfolios are growing. And the Signature 70 fund is the highest performing line across this period, followed by Synergy 70 and Skeleton 70. The black line is the Global Large Manager Watch median. So this is the median performance of the managers listed at the bottom. Why we compare against this median is, firstly, it is well accepted in the retirement fund industry that if you can outperform this line, then your portfolio has done very well. If you look at the names of these peers listed at the bottom that make up the Global Large Manager Watch median, it's Allan Gray, it's Coronation, Sanlam, all asset managers that are very experienced. They have had their businesses around for many, many years. They've been managing retirement fund monies in South Africa for decades. So they're very experienced in this space. And if you can beat the median performance, as I said, then your portfolio has done very well. And we can clearly see that all three of our ranges have comfortably outperformed this black line. The last thing I want to point out on this chart is that you can clearly see that dip that we saw in 2020 when there was all the nervousness in the markets around lockdowns and the COVID-19 pandemic. So it's a very sharp drawdown if you look closer to the top right-hand side, and a very fast recovery. This is what analysts refer to in the papers, calling it a V-shaped recovery or a square root-shaped recovery. So it's when the market kind of falls but recovers relatively quickly. And on peer comparisons, it's also interesting to have a look at how our portfolios have performed against peers in the market. Now, over the 1 year, we can see that the Skeleton and the Skeleton Synergy and Signature ranges are sort of in the middle of the 1 year numbers. So what we're looking at the moment is the low equity multi-manager survey. So all the portfolios that I have on the slide at the moment are all low in equities. So we're comparing like for like portfolios. It wouldn't be a very fair comparison to compare a very high equity portfolio to a low equity portfolio. So we are comparing like for like portfolios. If you have been attending these webinars month on month, you'll know that we've been at the top of the ranking tables, for many months in a row now. And our portfolios have performed phenomenally well. And what I need to try to explain is, when a portfolio has performed very badly in the previous period, so that's term that I used, coming off a low base. So if you had a terribly negative return as at 1 April 2020 to the end of March 2021, if you're coming off a low base and you're performing very well, then your 1 year return would look much higher than a portfolio that's protected more at the bottom, so it's not coming off such a low base and achieves a positive return. So this is basically an explanation as to why some portfolios that were the worst performing portfolios, if we looked at this last month or the previous month over the last couple of months. I know I have, for example, highlighted momentum portfolios previously that were always at the bottom. They've held a lot of property, some alternative asset classes. So the deeper in the red you were basically on 1 April 2020, the recovery that all portfolios have seen in the market. You saw the market performance was positive. All of these asset managers invest in the market. We saw positive performance across all asset classes. So if they recovered, but coming from further in the red, obviously that 1 year return does look higher. This is the reason that we're seeing that momentum portfolio now at the top of the ranking tables. Nevertheless, our portfolios have done well, with the Signature 40 fund being the best performing out of all 3 of our 40 portfolios in this low equity multi-manager survey over the 1 year. Over a 15-month period, that kind of measures the performance before the crazy volatility where we saw a lot of portfolios in the red. You can see that we are, right up there with the best performers, and the momentum portfolios, for example, are still further down. And of course, through looking at it over longer time periods, you have less of that effect of coming off a low base or very deep in the red in 2020. And you can see over a 2-year period, the skeleton and signature 40 funds have been the best performing. Over 3 years as well, top performing portfolios, and over 5 years, the skeleton 40 fund is only 0.1% the Alexander Forbes Conservative portfolio. For me, it's always important to look at retirement fund portfolios over the long term. We do expect members to be invested here for the long term, especially when we look at some of the more aggressive portfolios, such as your 60 and 70 portfolios. And you can see over 7 and 10 years, our portfolios have been the top performing relative to others in this low equity multi-manager survey. In the medium equity, again, that same effect, that's what I want to caution you on by looking at the 1-year numbers. So the further in the red you were, the recovery would look bigger as a percentage in terms of return from 1 April 2020 to the end of March. So in this low equity survey, you can see that the Synergy fund gave us 26.7%, and Signature and Skeleton are further down to the bottom. Over a 15-month period, that has less of that effect of some of the worst months. I mean, they are included in here, but you're not starting the measurement period there like you are with 12 months. You can see that the portfolios are at the top. Over 2 years, the Skeleton 50 fund has been the best performing against everybody else in the survey. Over 3 years, Signature and Skeleton at the top of the ranking tables. Over 5 years, only 0.1% behind the Old Mutual inflation plus 3 to 5%. And importantly, looking at them over a longer period, you can see that consistent performance over 7 and 10 years of our portfolios. In the medium equity survey, so this is where we compare our 60 portfolios with other portfolios that have roughly 60% allocation to equities. And again, over the 1 year, just as I explained, our portfolios are further down to the bottom because they were not as deep in the red on 1 April last year as some of the other portfolios. But over 15 months, you can see top of the ranking tables. Over 2 years, top of the ranking tables. 3, 5, 7, and 10 years, you can see that they're outperforming all other portfolios in the survey. And then the one to really focus on is the 70 portfolios. As I mentioned, we do expect most members to spend the majority of their working lives being invested in these portfolios. That's provided they are not making an active investment choice. When we look at our data, and this is also not unique to SURF, but other umbrella funds out there, most members do not make active investment choices. So most members default into the life stage model. So for me, it is very relevant to look at especially the long-term performance of the 70 portfolios. As I mentioned, most members will not be in these portfolios for 1 year, but they will be investing in these portfolios for decades. Over the 1 year, we can see the Synergy 70 fund out of our 3 portfolios has been the best performing. Having said that, last year, 1 April 2020, they were deeper in the red than the Signature and Skeleton fund. That is why now the 1 year return is so much higher. If we look at the 15-month period, we can see Signature has been the best performing portfolio. Over a 2 year period, Signature 70 outperforming everybody else in the survey. Over 3 years, again, Signature 70 at the top of the ranking tables, outperforming every other manager in the survey. Over 5 years, it's the Synergy 70 fund that has been the best performing. We can see the Alexander Forbes Performer portfolio, Old Mutual and Stanley Balance giving us 7.9 and 7.8% respectively, and our Signature and Skeleton range have also given a return over the 5 years of 7.8%. And very importantly, especially for this portfolio where members will be invested for the long term, is to look at the longer term numbers, and over 7 and 10 years, that consistent good performance of all 3 of these ranges is coming through relative to peers, and especially over 10 years, we can see that the Signature 70 fund has been the best performing portfolio, followed by the low cost Skeleton 70 fund. The way to interpret the longer term numbers across all of these surveys that I have showed you, these longer term numbers are what we call annualized returns, meaning had you invested in the Signature 70 portfolio for the last 10 years, your return would have been 12.4% per year for the last 10 years. And always interesting to compare against the single managers, not necessarily always a fair comparison. As I mentioned to you, our life stage portfolios, other than the Skeleton fund that doesn't invest in any active managers, but these are multi-managed portfolios. So we do utilize some of the single managers, we blend them with other single managers. So some of these managers are included in the construct of your portfolios. And we do expect single managers to have more choppy performance. So if you had to invest with Ford, for example, they might be at the top of the ranking tables in 2020, might be the worst manager in 2021. You might have to wait a couple of years for their performance to come back again. So you do expect more choppy performance. And this is due to them trying to differentiate themselves from one another, and they do that by having more concentrated, high conviction type of portfolios that follow a certain style. Now, not every style is going to outperform in every market environment, so depending on the style that they follow, it depends whether the market environment was right for the style that they follow, and that is really whether that will then show you whether they will outperform or not. So over the 1 year, as I mentioned, Coronation is one of the portfolios that is, for example, included in Synergy and Signature, but they have been the best performing asset manager, giving 43.1%. The Synergy fund is right behind them in terms of ranking the performance from best to worst, and you can see the Signature and Skeleton portfolio sitting somewhere in the middle. Of course, in these charts, we have that same effect. Managers that were very deep in the red on 1 April 2020, if their performance has come back, simply measuring from further in the red gives you a higher performance than if you weren't so far in the red. So you have to remember that there is that effect, of course, when you are looking at returns over such a volatile environment. Over a 15-month period where we try to have that starting point that was not, the worst of what we saw in the markets, we can see that Coronation was the best performing, with Signature just behind them. And again, we see the same over 2 years, over 3 years, over 5 years, but over 7 and 10 years, what's very interesting to see is that especially over 10 years, none of the single asset managers have managed to outperform the Signature 70 fund. So there's that consistency in returns that I spoke about, where the Signature 70 fund, through our risk management framework, where we try to manage risk in the overall portfolio and to consistently give you good returns for the risk taken, you can see that portfolio has done really well over the long term. Lastly, on the risk and return characteristics relative to other managers, it's all good and well to look at just the absolute performance, but it's important to also have a look at how much risk a portfolio is taking on to give you that return over the long term. When a portfolio is riskier than another portfolio, it simply means that there's more risky investments in that portfolio. So if you have more equities, more property, more offshore investments, more of these unlisted instruments or hedge funds, alternative investments, all of those type of asset classes increase the risk in the portfolio. Whereas a portfolio that's mainly bonds and cash, is not that risky, and it would be then further left if you look at the scatter plot. So risk again is on the horizontal axis. The further right you look, the more risk a portfolio is taking on, and the further left you look, the less risk a portfolio is taking on. And return is on the vertical axis. So essentially, for every level of risk, you would want the top performing portfolio. So looking at our signature range, for example, you can see it's taken on about 9% of risk, and all the portfolios that plot underneath that. So looking at Momentum Flexible 6, 27, 4, CPI plus 7, the Sanlam MM60, all of these portfolios have taken on just as much risk as Signature 70, but they simply haven't delivered as high of a return. And the more extreme portfolios are the one to the right. So all of these momentum portfolios in Sanlam MM70, they've taken on more risk than Signature 70, but have not been rewarded for the risk taken over the 7-year period. So again, from a risk and return perspective, we're very happy with the performance of our portfolios across all three ranges. Now, as I said to you at the beginning, I wanted to chat to you about thematic investing and to show you how we actually implement this in the management of your portfolios. Now, thematic investing is not something that's new to us. It's something that we have been practicing for the last little while, but I just wanted to highlight it to you so that you can see that there is thematic exposure in the portfolios that you or your members may be invested in. Now, thematic investing is all about trying to look ahead into the future and trying to establish what sort of sectors of the market we believe will outperform in the near future. So you often even hear people say electric vehicles are the future, or there's so much pressure on environmental issues that going green is the future. So looking at almost statements like that, you can almost establish what could potentially be some really good performing sectors of the near future. So if you truly had to believe that electric cars are the future, then why not look at a certain sector of the market? These days, you can invest in pretty much anything. There's an index for anything. There's an ETF for almost every sector of the market. So you could, for example, if you wanted global exposure to electric vehicles, you could do some research online or speak to a financial advisor always, and you could access an investment that would potentially just measure the performance of companies that are busy innovating in the space of electric vehicles. So in very simple terms, this is what thematic investing is all about. It's looking into the future and trying to establish today what sort of themes may play out over the next couple of years. And of course, if those themes really do play out and everybody is using electric vehicles in 5 years' time, and if you invested in electric vehicles today, then you would very likely benefit from that in terms of good returns. So when we construct our portfolios, we do use a core satellite approach to portfolio construction. So if you look at that middle portion, the core of the portfolio, this is where we have our traditional asset classes. The pluses and minuses show you whether we are slightly overweight or underweight to these asset classes, which I did show you in the asset allocation slide a little bit earlier on. But our traditional asset classes, such as local equities, local bonds, global equities, and global bonds, that's the core of the portfolio. But the satellites are the kind of thematic exposure that we would want to have exposure to in these portfolios. Now, if I start at the top, specialist real estate. Now, we know that, and we have seen, if you've been looking at these numbers on a month-to-month basis, property has really struggled through the pandemic. And the reasons why property has struggled through the pandemic is we've been sitting at home, office space is going unused, people have been struggling financially. So when they do go to the shops, maybe they're not shopping as much, maybe people are afraid to go out. So malls have suffered as well. So we've seen office space suffering, Malls are struggling. I'm sure wherever you may be based, if you've gone to the local mall in your area, you'll see a lot of shops are closed, a lot of vacancies. The shops that are still there are paying reduced rentals. So the property companies are not earning as much as they were a couple of years back. But having said that, the specialist real estate that we are focusing on here is not South African real estate. It's on the global side, and it's specifically looking at the 40 largest, most liquid developed market property holdings. So we gain this exposure through an exchange traded fund, an ETF, and this ETF tracks the 40 largest, most liquid developed market stocks. Now, if you had to look at the businesses of those 40 stocks, these 40 stocks are mostly involved in what we call diversified real estate. So firstly, there's no exposure to hotels and leisure. So hotels and leisure is an area of the market that we are a little bit concerned with. We do think that it will only be back to 2019 levels maybe at the end of next year. People are not traveling for the kind of same reasons that I spoke about, even with regards to property. I mean, people are struggling, they may be afraid. So all of those factors have to be considered. And then, of course, there's restrictions. Even if you wanted to travel and you weren't afraid, maybe the governments won't allow you to enter certain regions. So there's no exposure to hotels and leisure if you look at that specialist real estate. There's very little office and residential REIT exposure. And it's mostly diversified real estate, meaning these are companies that are involved in various sectors of the property market. And if I can give you some examples of what some diversified real estate could be, is you could, for example, have companies that own a lot of land and cell phone towers go up in that land, or data centers. So in these types of sectors of the property market, you can actually expect to do well even in the current market environment. So we do have some exposure to specialist real estate. Then at Sygnia, we've always loved tech. And our tech exposure previously used to be through the FANG funds in these portfolios. And at the moment, we're rather investing in the Fourth Industrial Revolution Fund, which I will show you one or two slides about a little bit later on. But tech, again, looking into the future, thinking about technology as a theme, and we're saying to ourselves, well, there's so much technological innovation. It definitely is a theme for the future, specifically the kind of technologies in the Fourth Industrial Revolution Fund, which I will show you over the next slide. So this is definitely exposure that we'd like to have in the portfolios. Then I'm going clockwise from the Fourth Industrial Revolution Fund. If you look closer to the bottom, emerging markets. So emerging markets are definitely a theme. If you think about China specifically, making up a huge portion of emerging markets indices. China was in lockdown, out of lockdown, back to operating at almost full capacity, exporting to the rest of the world, the only G20 country that managed to grow in 2020. And they're really focusing on innovation and technologies for the future. So it's definitely a region that cannot be ignored. A lot of the middle class the middle class is actually growing as a percentage of the populations in these Asian economies. So definitely a theme that we would want to have exposure to. Health is another big theme. So we're still finding ourselves in a pandemic, and there's been a lot of focus on health. Governments have been spending a lot on health, and they are set to actually increase that spend. If anything, the COVID-19 pandemic has showed us that there are cracks in a lot of countries' infrastructure, and if you watch the news, you see people queuing outside of hospitals. This is highlighting some of the issues in the healthcare sector. But forgetting about COVID-19, let's hope that it's all over and behind us sooner rather than later. So even if we're not thinking about only pandemics, people are living longer and longer, especially in the developed economies. And that is possible due to the innovations in healthcare. And in addition to that, speaking of innovations, there's so much innovation in the healthcare industry where it's possible to have a human organ being printed by a 3D printer. It's possible to use artificial intelligence to diagnose a disease. It's possible to use virtual reality to simulate training environments so medical professionals can almost, view in practice what an operation would be like. So considering all of those aspects, coupled with the fact that, yes, we do find ourselves in a pandemic, and a lot of experts are saying that due to climate change and simply how interlinked the globe is, people are traveling, from continent to continent. If you consider all of that, they're also saying that maybe it won't be another 100 years before we see the next pandemic. It might come a lot sooner. So major focus on healthcare. And again, from a theme perspective, if you have to look over the next couple of years, will this be a theme that will play out? Well, we believe that yes, it is. And that's why, as a theme, we have included that thematic exposure to healthcare in your portfolios. And then on the local side, there's been some, and I'll touch on it again when I touch on the Regulation 28 changes, but you'll know that our president has come forward to say we really need to talk about infrastructure. We need to upgrade the infrastructure of South Africa, and infrastructure is also a great way to solve some of the problems caused by the pandemic. If you start building new bridges or highways, you can also hire South Africans. That way, you will improve the unemployment rate. These people will now earn a salary. They can support their families, put food on the table, and contribute to the tax base. And when South Africa infrastructure looks better, we will be more attractive from an investment destination perspective. Foreign investors looking into South Africa, maybe they will want to come and expand their operations into Africa through our country if we have good roads, good airports, and everything works. So another area that we are looking at, we're starting to include some exposure to this in your portfolios. Now, I have included a couple of slides just to highlight some of the themes that I've already spoken about. But looking at the Fourth Industrial Revolution Fund, I said, Sygnia has always liked tech, and this is the type of tech that we are more focused on right now, and we have included in your portfolios. So we have included exposure to the Fourth Industrial Revolution Global Equity Fund. And if you look at the Fourth Industrial Revolution Fund, well, what is the Fourth Industrial Revolution Fund? Well, it's a fund that tracks the performance of the Kensho New Economies Index. And if you look at that index, essentially it invests in companies that are involved in these technologies. So space exploration, drones, autonomous vehicles, cybersecurity, nanotechnologies. So just when you're looking at the slide, you can see how this fits into thematic investing. It's all about looking into the future, what kind of technologies may play out, and investing in that today. And on the next slide, you'll see the rest of these sectors that the Fourth Industrial Revolution Fund invests in. So there's also clean energies in there. There's, future payments index. So there's various, future kind of technologies that companies today are working on that we believe will drive the Fourth Industrial Revolution. Emerging markets, I already spoke about, the strength of China and these Asian economies. But what are emerging markets? Well, emerging markets are really these economies that are between the stages of developing and developed. A developed market would be, for example, the Eurozone or America. And despite the volatility with emerging markets such as South Africa, Brazil, China, you can expect larger growth from these economies over the long term. Looking at Vanguard is a very, very large global asset managers. So at the end of 2020, they updated their projections of what they believe the growth will be from various economies around the world. And you can see, the colors aren't coming through so well, but the various dots from each region show you the 2020 growth projection as of June. the 2020 growth projection as of April last year, and what the 2021 growth projection is for the regions. And you'll see that emerging and developing Asian economies actually have the highest growth projection. So looking ahead for 2021, we do expect the strongest growth to really come from China and those Asian economies. Even if you look at 2020, or even the one-year number that we saw to 31 March, when we look at those MSCI world indices, it was very evident to see that emerging markets have actually already outperformed developed world. A lot of it has to do with China being a big part of that, and Chinese GDP just in the fourth quarter grew by 6.5%, and the Chinese economy grew by 2.3% in 2020. Commodity prices have also contributed to that strong performance, and all of this infrastructure spend that will come through from a lot of governments, including South Africa, but America's got a big infrastructure drive. That will be another aspect that affects emerging markets, especially commodity producing emerging markets, positively for the future. Then the World Bank and IMF have also predicted that by 2024, 4 of the 5 largest economies in the world will be Asian economies. So again, definitely a region of the world that cannot be ignored in terms of growth forecasts. And the economic outlook, this was updated in January 2021. Again, the IMF, what they expect from various regions, you can see that global economies are expected to grow by 5.5% in 2021 and 4.2% in 2022. Advanced economies, less growth. They expect 4.3 for 2021 and 3.1 for 2022. And the furthest right is the emerging markets and the developing economies. So growth on average for those economies is expected to be 6.3% for 2021 and 5% for 2022. So again, emerging markets relative to your more developed economies, we do expect higher growth from these regions going forward. So definitely a theme, emerging markets that cannot be ignored. And then I already mentioned this, but it's really the middle class that is the source of economic growth. A strong middle class provides a strong consumer base. It's the middle class that consumes, and it's really important to kind of monitor the growth of the middle class in various regions. And if you look at this little diagram that I have included on the left, you can see that the Asia Pacific region, and again, apologies, the colors haven't come through too well, but the Asian Pacific region at the moment accounts for 54% of the world's middle class. And by 2030, so over the next decade, we expect 65% of all the middle class people in the world to be from Asian economies. Again, proving the point that it's definitely a region that we cannot ignore in terms of growth prospects. And then healthcare. So I touched on healthcare a little bit when we looked at that core satellite diagram, but just looking at the market cap of these global pharmaceutical companies, I mean, the market cap of the 5 largest pharmaceutical companies are bigger than the JSE, than all the stocks put together on the JSE. Their profit margins are massive, anywhere between 5 and 95%. There's a change in demographics, people also living longer. The spend in terms of from governments on research and development and on healthcare in general is only set to increase going forward. And there are so many, advancements in healthcare, as I mentioned, such as 3D printing. You can print a human ear, the virtual reality that I mentioned, biosensors and trackers might be used in the very, very near future to kind of alert you that something may be wrong with your body. So there's just so much innovation in healthcare. Again, a theme, if you look today and you think about what will healthcare look like in the next 5 or 10 years, well, it will look very differently. It's a theme that's playing out, and we want to invest in it today so we can benefit in the future. And then through everything that we do, we cannot forget about ESG. So ESG is when you're investing with a focus on environmental, social, and governance factors. Some of you may be aware that we recently launched an ETF that tracks performance of global markets, specifically heavily weighted towards mostly the US, but with about 5% exposure to emerging markets, that has this ESG overlay, meaning that all of the stocks that we track in that index are ticking the boxes in terms of ESG. So they're doing the right things in terms of environmental, social, and governance factors. So again, looking ahead, more and more regulation around ESG, more and more focus on environment, on whether companies are treating their employees and customers properly. Governance, especially, I mean, in South Africa, we all remember Steinhoff, and governance is becoming increasingly important for companies to be transparent, for their reporting to be transparent. So these are the kind of themes that we have included in your portfolio, and these are the themes that, looking ahead, we do believe that by investing in them today, they will play out over the next couple of years, and our investors will benefit from them. So looking at the asset allocation of your portfolios and the various strategies that we have in place, as I mentioned, the Signature 70 portfolio is a blend between active and passive managers. So if you look at the SA equity building block at the top, you'll see that we have the Sygnia Swix tracker. So that's a passive component. It tracks the Swix index exactly. So it's a replication of the Swix index, totally passive. But then you also have ABAX, 91, and Coronation. Those are your active managers that are included in your portfolios. Likewise, in the bond space, we've got Coronation, which is an active manager, and you have the Sygnia passive bond fund that tracks the all bond index exactly. On the global equity side, mostly passive, but this is where I wanted to highlight to you that we're not simply just saying, okay, let's invest offshore, let's just choose any offshore index that will give us offshore exposure. There's a lot of thought that goes into what kind of exposures do we want, and this is where you see the thematic exposure playing out. So you'll see that I spoke about emerging markets, these Asian economies, China, that we're all very excited about, while you do have exposure to emerging markets in your portfolios. I spoke about tech. Despite the fact that you're getting some tech through your traditional indices like S&P 500, MSCI World, those kind of indices have a lot of large exposures to Amazon, to Netflix, to Alphabet. So a lot of the tech stocks are in there anyway, but over and above that, we've also included some exposure to the Fourth Industrial Revolution Fund that's investing in all this space exploration and artificial intelligence and all these futuristic kind of technologies. And then health, I spoke about health. Here you can see your exposure to the Health Innovation Global Equity Fund, and ESG, being something that all investors should be thinking about. We've got the Sygnia International ESG portfolio. This is your investments into the Oxford Sciences Innovation Fund, again, with the health focus, but also impact kind of investing. So this is how we are implementing thematic investing in the portfolios that you're invested in. So if I just show you the Skeleton 70 fund, the only difference between the Signature fund and the Skeleton fund is asset allocation is all the same, but you don't have any active managers. So you'll see in the equity and the bond space on the local side, you just have the passive portion. So the Swix tracker and the Sygnia passive bond fund. The offshore portion of all of these portfolios, all three ranges, Skeleton, Signature, and Synergy, are all exactly the same. And then the Synergy range on the local side made up of Allen Gray, Coronation, 91, and Prudential. And on the global side, as I said, the global portion of portfolios all have the thematic exposure to the various themes that I already showed you in the previous slides, but exactly the same. And then the last thing I want to mention is just some of the proposed changes to Regulation 28. So Regulation 28 is the piece of legislation that tells us how we can and can't invest retirement fund monies. And due to all of this talk about infrastructure and wanting retirement funds to support these infrastructure projects. The regulators then are proposing to make some changes to Regulation 28. So what they're proposing is to define infrastructure. So infrastructure previously wasn't defined, now they're defining it, and it really is, it's all real assets. So physical real assets that you can see, like your bridges and energy generating assets. And they're saying that retirement funds can invest up to 45% in infrastructure. 45% sounds like a lot, but it is across asset classes. So you could invest in infrastructure through bonds, you could invest in infrastructure through private equity as well. So looking at all of those asset classes collectively, upper limit of 45%, with an additional 10% into Africa, there's no lower limit. So if a retirement fund doesn't want to invest in infrastructure, that's fine as well. So there's an upper limit. And then the last thing is, previously hedge funds, private equity, and other asset classes had a collective limit of 15. And now they are delinking that group of hedge funds, private equity, and other asset classes. And it's proposed that private equity has its own limit of 15%, hedge funds has its own limit of 10%, and other assets has 2.5%. Having said that, the regulator sent these this proposed draft at the end of February. The industry was invited to comment by the 29th of March. So Sygnia sent through our comments, and now we wait for the final regulations to be issued. So I see it's already 10 o'clock. There are a couple of questions. I will tackle these quickly, but if there's anything else, please feel free to email us and I'll get back to you on email. So the first question is, why do we have such low exposure to the Fourth Industrial Revolution Fund when it's seen as a significant thematic investment? So the exposure is low, but as I mentioned, tech is something that we like. We want exposure to tech, but we cannot forget that you already have exposure through tech, through the MSCI World, through all of your emerging markets, and through the S&P 500. So all three of those are already in your portfolio. And if you have to look through what are some of the large stocks that are driving those indices, well, it is Amazon. On the emerging market side, it's Tencent, it's Alibaba. So you're already getting so much tech exposure through that although we've included the Fourth Industrial Revolution Fund as quite a low exposure, it is still an overweight exposure. So that is the reason why it's relatively low, but nevertheless, it adds to the tech exposure that you already have. 2 minutes past 10, so I will stop it here in terms of questions. But as I said, please feel free to email and we will get back to you. So I want to thank you for your time this morning. And please join us next month where Denisha will cover a summary of some of the big economic events that we've seen at the beginning of 2021. Thank you.